The price is lying and the spread is telling the truth. And the next 72 hours are where that truth usually forces the market to confess. Because right now, gold is trading around $4,970 an ounce, and silver is hovering around $93. And you can feel the institutional discomfort in the way every dip gets eaten before it even looks like a dip. There's a camp that wants this cooled off, capped, normalized. There's another camp that doesn't care about anyone's comfort because they're staring at tightness signals that don't show up in headline price. And that's where the real pressure starts. Here's the payoff you're getting by the end of this. The one mechanism that can turn a calm-looking chart into a forced buying event. And the level that matters more than the level everyone is tweeting. And a near-term checklist for what confirms the next leg versus what breaks the setup. Not someday. This week, in the next 72 hours. Because if this one piece flips, the math changes. Let's start with the street symptom because it is the easiest way to know whether a move is just a chart or something uglier and more powerful. When metals rip like this, it doesn't stay politely inside your candlesticks. Liquidity thins. Quotes get weird. Spreads widen at moments they shouldn't. Dealers suddenly have availability conversations instead of price conversations. The vibe shifts from trade it to source it. But that's not the part that matters. The part that matters is what's happening underneath the price, how the market is pricing time. Most people think gold is gold and silver is silver, and that's the whole story. But the market doesn't just price the metal, it prices the urgency. It prices the right to get it now versus the promise to get it later. And when that urgency starts showing up in the structure, and when near-dated pricing gets bid relative to the deferred months, you are no longer talking about a normal speculative rally. You're talking about a market that is paying up for immediacy. That's your hidden detail. And once you see it, you can't unsee it. Here's why that matters in plain English. In a normal world, if you want a metal delivered later, you usually pay a little more because money has a cost, storage has a cost, insurance has a cost. That gentle upward slope into the future is the boring baseline. Contango, cost of carry, finance 101. But when the slope flattens or flips, when near-term metal is more expensive than later metal, something is tight in the part of the market that actually touches reality. And when that shows up in silver especially, it tends to show up with teeth. Now, I'm not telling you to assume every backwardation print is the apocalypse. I'm telling you it's a flare gun. And the next detail is what flips the whole setup. The moment the market starts paying you to delay delivery, it's signaling that the immediate pipe is the bottleneck. Not the theory, the pipe. So what forces people to do something about it? Futures. Futures aren't just a scoreboard, they're a set of obligations. And the mechanics of those obligations are exactly where retail investors get blindsided because they are watching price, while the pros are watching flows, spreads, and inventory categories. That sounds technical, but it is actually simple if you frame it like this. There is metal that exists, and then there's metal that is deliverable, and then there's metal that is deliverable right now without a chain of paperwork, timing, and logistics. Those are three different things, and the market prices them differently when stress rises. In the gold and silver complex, the paper side can trade huge volume without a single ounce moving. That's normal. That's liquidity. But if the physical side gets tight, or if market participants fear it could get tight, then the paper side starts behaving differently. Calendar spreads start shouting. The front month starts getting pulled. Arbitrage routes get activated. Inventories become a story again. And that's where people get hurt, because the tape speeds up when the pipeline narrows. Here's a quick way to visualize the pressure. The Standard Comics gold futures contract represents 100 ounces. At 4,770, that's about $467,000 of notional exposure per contract. Silver is 5,000 ounces per contract. At $93, that's about $465,000 notional. That similarity in notional is one reason both markets can become leverage sensitive in the same week. A small move isn't small when you're levered. And when you're levered, margin is the invisible hand that forces decisions. But that's not even the nastiest part. The nastiest part is options, because options are where the market's opinions turn into the dealer hedging engine, and the dealer hedging engine can turn into a reflexive loop. Translation, the market can end up buying because the market already went up. That sounds stupid until you see it happen. And when it happens fast. Here's the clean explainer without the textbook voice. Dealers sell options. When they sell calls, they often hedge by buying some futures or spot exposure to stay neutral. The amount they need to buy changes with price. That sensitivity is delta, and the speed at which delta changes is gamma. When gamma is high around crowded strike zones, a move up forces dealers to buy more as price rises, which can push price up more, which forces more buying. That's the gamma squeeze dynamic. It's not emotion, it's math. But it cuts both ways. If price falls back through that same zone, the hedging can flip. Dealers who were forced buyers can become forced sellers. And that's how you get those candles that feel like someone kicked the ladder out. Same thesis, same macro backdrop, totally different tape for a few hours. This is why you need a psychology shield. Because volatility will try to convince you the thesis changed when all that changed was hedging pressure. Keep that in your pocket. You're going to need it. Now let's talk technical setup in a way that actually respects how metals trade, because these markets don't behave like meme stocks, and they don't behave like sleepy bonds either. They have this weird dual personality. Long periods of slow grind, then sudden air pockets, then violent repricings that look like a glitch until you remember the positioning and the leverage. Gold, right now, is in that new highs with shaky legs posture. The chart looks strong. It is strong. But strong markets also create fragile structures because the crowd gets one-sided. When gold is making fresh highs, the first thing I watch isn't the high itself. It is the shelf underneath, the zone where the last breakout happened and where dip buyers have been trained to respond. That shelf becomes your near-term support, and the market is going to test whether it's real. Silver is the same movie with louder sound. Silver doesn't tiptoe. It does that thing where it runs so far, so fast, that your brain starts treating the move like a personality trait. It only goes up. That's when it's most dangerous, because silver loves to whip 5% to 10% in a heartbeat, even in a bull phase. And those whips are exactly how people get separated from good positioning. Not by being wrong, by being early, levered, and emotionally reactive. So what are the levels? I'm going to keep this credible and not fake precision because exact lines are different depending on whether you're watching spot, front-month futures, or an ETF. But the concept holds. For gold, the level that matters in the next 72 hours is the most recent breakout base, the last zone where price consolidated before the latest push higher. If gold holds that zone on a pullback and then reclaims the intraday momentum, it's telling you the move has depth. If it slices back through that zone, closes heavy, and can't reclaim it quickly, the market is telling you something else, that the rally is being carried more by positioning than by fresh demand, and that distinction decides whether we get controlled retest or air pocket. For silver, your key level is the nearest round number magnet plus the prior impulse base below it. Silver loves round numbers because they concentrate options, strikes, and psychology at the same time. That's where the dealer hedging engine meets the human nervous system. If silver holds that base on a pullback, the trend stays intact. If it loses it and can't snap back, silver can drop faster than it rose, not because the story ended, but because the leverage needs to breathe. And that's where the real pressure starts. Now we need to answer the question everyone pretends they don't care about, but absolutely does. Why now? Because the calendar is loading the spring. There are two big calendar forces looming over this market, and they matter, even if the dates aren't inside the next 72 hours, because positioning starts before the event. The first is the Federal Reserve meeting on January 27th, 2026. The second is the options calendar around that same period in metals, where large exposures can cluster and dealers adjust hedges as strikes get approached. Here's the part most people miss. The market doesn't wait for the event to move. It starts gaming it. It starts shifting hedges. It starts rolling exposure. It starts pulling liquidity. The 72 hours you care about are often the early tremors, not the earthquake. Because if the market senses that a policy week could create gap risk, participants either de-risk early or they pay up for protection, and both behaviors can move price, especially in metals where confidence risk is its own asset class. And that brings us to the macro conflict that's been pouring fuel on this. The rally has been happening in a climate where investors are increasingly sensitive to the idea of institutional credibility, especially central bank independence, being challenged. There, it's been intense public attention on tensions involving political pressure on the Fed and scrutiny of the Fed chair, which, regardless of where you stand politically, tends to do one thing in markets. It raises the perceived risk that policy becomes less predictable. Less predictable policy means higher uncertainty premium. And gold is basically a receipt for uncertainty premium. But don't stop there, because silver is not just a monetary metal. Silver is also an industrial metal with a supply chain that does not flex easily, and that's why it can go from ignored to unhinged in a single quarter. Silver's supply problem is structural. A lot of silver production is byproduct, meaning it comes out of the ground alongside other metals like copper, lead, zinc. You don't just decide to mine more silver because silver price went up this month. You need new projects, new permits, new processing capacity, new refining throughput. That's lead time. That's friction. That's why when demand surges, especially industrial demand, you can get tightness that shows up first in spreads and premiums, not just in the headline spot quote. And if you want a real-world driver that helps explain why silver can stay bid, look at the industries that quietly consume it. solar, electronics, electrification supply chains. Even if some end markets slow down, the baseline demand doesn't vanish overnight. Meanwhile, any disruption, export controls, tariff fears, inventory hoarding, can create a temporary scramble. And temporary scrambles are what create those front-end tightness signals. Now connect this back to the hidden detail. Price is the headline, spreads are the heartbeat. If near-term silver is trading rich relative to later months, or if you're seeing signs of backwardation, you're seeing urgency. If you're rehearing reports of physical metal moving between hubs, like metal migrating from one storage center to another because the market is trying to satisfy delivery preferences or avoid policy friction, that S, not a retail narrative. That's infrastructure reacting. And when infrastructure reacts, paper has to follow, because arbitrage is the tether between markets. Here is arbitrage in one clean sentence. If the price of metal in one place is meaningfully higher than another place, someone will try to buy the cheaper one and deliver it into the expensive one after accounting for shipping, financing, insurance, and time. That flow pulls prices together. It's like gravity, but gravity has a speed limit. Ships don't teleport. Vaulting doesn't happen instantly. Refining doesn't accelerate because your chart looks bullish. So while arbitrage is the long-term equalizer, in the short term it can actually create stress. Metal gets pulled from one hub, making that hub tighter, while the destination hub absorbs, changing its spreads. That is why you can have a world where inventories look fine in aggregate, but the deliverable immediately available category is the one that matters. And if that category gets tight, the market doesn't care that there's metal somewhere. The market cares if it can be delivered against obligations now. This is where institutional flows add the next layer of proof. When metals are trending hard, you often see flows into ETFs and ETPs accelerate. That's not just people buying. It's channels of demand that require authorized participants to source metal or hedge exposure. Some of that demand is synthetic. Some of it touches physical. Either way, it changes the hedging landscape. It changes who needs to do what on a pullback. It changes the reflexivity. Add positioning on top of that. As a rally extends, shorts get pressured. Not every short is evil. Many are hedgers. Many are spread traders. Many are systematic. But short exposure still has one universal law. If price goes against you far enough, you either add collateral or you reduce risk. That means margin calls and forced covering. That's the margin spiral spine. And silver, because of its volatility, can trigger those spirals faster than people expect. Now let IS stack the proof points, so this doesn't sound like one of those, trust me bro, metal rants. Proof point 1, price is at record high territory. Gold around $4. 670 and silver around 93. Meaning we are in a regime where prior references are thin, and positioning can become unstable simply because the market has fewer natural taunt sellers at these levels. Proof point 2, term structure signals have been described as tightening in silver, with episodes of backwardation being cited as a sign that near-term demand is intense relative to supply available right now. Proof point 3, options activity is elevated in this kind of tape, and crowded strike zones can create gamma-driven acceleration in either direction. That's not a narrative. That's how dealer books behave when volatility meets concentration. Proof point 4, institutional credibility risk, especially around central bank independence and policy predictability, has been front and center, and gold is a direct beneficiary of that kind of uncertainty premium. Proof point 5, supply chain rigidity in silver due to byproduct constraints and lead times makes it uniquely prone to short-term squeezes that show up first in availability, premiums, and spread behavior. And if you want proof point 6, here it is. The psychological behavior of the crowd changes at these levels. People stop thinking in probabilities and start thinking in identities. I'm a gold person. I'm a silver person. The system is broken. This is the top. This is the start of the end. Identity-driven positioning is how markets overshoot. And overshoots create the volatility that institutions use to shake weak hands, which brings us to your psychology shield. Because if this thesis is right, if there's real structural tightness, if macro uncertainty is fueling flows, if options hedging can accelerate, then you should expect violent whipsaws. Not despite the thesis, because of the thesis. Here's how volatility plays you. It makes you confuse speed with truth. A sharp red candle feels like the story is over. A sharp green candle feels like I'm missing it forever. Both feelings are useful to the market because they cause bad timing. The market wants you to sell the retest and chase the extension. That's the emotional tax. So you need a simple rule. Separate trend signal from noise. Trend signal is structure. Does the market hold the breakout shelf? Does it reclaim it quickly after a flush? Do spreads stay firm? Does the dollar and yields behave in a way that supports the move? Do pullbacks get bought with volume, or do they drift with no bid? Noise is the intraday drama designed to harvest stops. Noise is a wick below support that reverses in 20 minutes. Noise is a headline that hits when liquidity is thin. Noise is the everyone is doomed candle that gets fully retraced before the close. If you can't tell the difference in real time, you don't need to. You just need to stop making decisions at the emotional peak. That's your shield. Now, the next 72 hours. Here's the 2-scenario lens that keeps you sane and keeps you credible. Scenario 1 is the controlled pullback and retest. This is where gold and silver cool off without breaking structure. You'll see a dip into the prior breakout shelf. You'll see buyers step in. You'll see the tape stabilize. And you'll see the market try to climb again. In this scenario, volatility still happens, but it's constructive. It's the market resetting leverage. It's dealers rebalancing. It's late longs getting shaken out. And then the trend resumes. If this happens, the confirmation is simple. The retest holds and the next push makes a higher high without the market feeling hollow. Scenario 2 is the continuation squeeze. This is where dips don't fill and the market starts gapping. It feels unfair. It feels like you can't get in cleanly. That is exactly what a squeeze feels like because the market is trying to force in the last buyers at the worst possible price. In this scenario, watch for signs of urgency. Aggressive buying in the front month, strength in calendar spreads, heavy call activity, and the kind of intraday behavior where price breaks a level and never gives you the polite pullback. Now, here's the most important part. Both scenarios can happen in the same week. You can get a controlled retest first, then a squeeze, or you can get a squeeze first, then a brutal retest that looks like betrayal. That's why you don't anchor to one path. You anchor to levels and mechanisms. So what are the levels and what invalidates the thesis? For gold, if you see a clean break below the recent breakout shelf and it does not reclaim it quickly, if it starts closing heavy and the bounces are weak, that's your warning that the move is more fragile than it looked. Not over, but fragile. Fragile means wider swings, deeper pullbacks, and a higher chance of a temporary trend break, even if the macro story remains supportive. For silver, because volatility is higher, invalidation is less about a single wick and more about behavior. If silver loses the prior impulse base under the nearest round number magnet and then can ET snap back, you have to respect the possibility of a fast downdraft. Silver doesn't need permission to drop 8% on the way to being bullish again. And if you don't prepare for that, you'll get emotionally forced out at the worst moment. That's the trap. Now let's tie this back to the dealer hedging engine because this is where the next 72 hours can get spicy. When price hovers near crowded strikes, especially around numbers in silver and big handles in gold, dealers are constantly adjusting. If price grinds upward into those strikes, dealers often have to buy more to stay hedged. That supports the tape. But if price suddenly drops away from the strikes, that hedging can unwind and amplify the move down. It can look like somebody knows something, when really it's just positioning meeting math, but that's not the part that matters. The part that matters is what you watch to tell the difference between a hedging flush and a thesis break. Here's your near-term checklist. First, watch the response to pullbacks at the breakout shelf for gold and the impulse base for silver, not the wick, the response. Do buyers step in quickly, or does the market feel like it's falling through air? Second, watch the front-end tightness signals. If you hear or see continued signs that now is being bid, whether that SS in spreads, premiums, or short-dated pricing, then the underlying demand story remains alive even through volatility. Third, watch the macro posture into the January 27-28 Fed meeting. Markets often price the risk of surprise through volatility and positioning before the decision. If policy credibility risk remains in the conversation, gold tends to keep its bid. If that risk suddenly evaporates or is credibly resolved, you can see a relief move that temporarily pressures metals, not because metals failed, but because the uncertainty premium compresses. Fourth, watch the dollar and real rates behavior. You don't need to be an economist. You just need to notice whether the macro tape is aligned with metal's strength or fighting it. When metals rally, while the macro backdrop fights them, it can mean something structural is going on. When metals rally with a supportive macro tape, it can mean the trend is broad and smoother until it isn't. Fifth, watch positioning stress. This shows up as sudden bursts of volume, sharp intraday reversals, and a general feeling that price is being pushed by necessity rather than preference. Forced buying has a different sound than discretionary buying. It's urgent, it's relentless, and then it disappears without warning. That's why you respect it, but don't worship it. Now, let me say the thing that will keep you from getting hurt. Price can whip around violently even if the thesis is correct. In fact, the stronger the thesis, the more likely the market uses volatility to extract pain, because pain is how liquidity is created. People don't hand over good inventory cheaply unless they're scared, so the market scares them. That's the game. So if you're watching gold at $4,670 and silver at $93 and thinking, it's too late, remember this. Late is a feeling, not a fact. The fact is structure, positioning, and mechanism. You don't need to chase. You need to know what must be true for the move to continue, and what would prove it isn't T-true. And here's the final hidden twist. The one metric everyone pretends is boring until it saves them. The market S price of time. If the market keeps bidding now relative to later, if the front end stays tight, if spreads stay firm even when price pulls back, it's telling you demand is not just speculative, it's logistical, it's structural, it's forced. If, on the other hand, you see the urgency fade, spreads relax, the front end softens, pullbacks get heavier and recoveries get weaker, that's your clue that the tape is transitioning from tightness-driven to positioning-driven. And positioning-driven moves can still go higher, but they tend to be more fragile and more violent. So here is how I frame the targets without pretending we can draw a ruler on chaos. In gold, the next upside objective is simply continuation into clean air above the recent highs, but only if the breakout shelf holds on a retest. In silver, the psychological magnet is the next big round number above here, but the path is the story. Does it stair-step with retests, or does it rip and gap? If it rips and gaps, that's squeeze behavior, and squeeze behavior is not where you get cute with leverage. And your invalidation? Gold loses the breakout shelf and can't reclaim it quickly. Silver loses the impulse base under the nearest big handle and can't snap back. Those are the lines where the tape stops being constructive volatility and starts being deleveraging. One more thing, because if you're still here, you're not here for dopamine, you're here for edge. The institutions that look smartest in these moves aren't the ones who predict the exact top or bottom. They're the ones who don't let the market bully them into emotional timing. They size appropriately. They expect whipsaws. They respect the calendar. They watch the structure. They watch the spreads. And they stay patient enough to let the market show its hand. If you want to be in that camp, act like it. Don't worship a single candle. Don't let a headline hijack your process. Don't confuse a flush with a failure. And don't confuse a pump with proof. Over the next 72 hours, watch those retest zones. Watch whether the urgency signal stays alive. Watch whether the market starts behaving like it's being forced rather than chosen. And remember, the move that looks obvious on the chart is usually the move that gets you chopped up unless you respect the mechanism underneath it. And near the end of this week, as we move deeper into late January, and closer to that January 27th to 28 policy window, keep your eyes on what the market is quietly doing before it loudly does it. Because the real story almost always shows up in the structure first. And only later does it show up in the headline. If you're the kind of person who wants the checklist, the mechanism, and the what breaks if X happens instead of the hype, then you already know what to do. Stick around this corner of the market with the people who actually watch the plumbing, not just the price.